All right. Excited to be here. This is my third ETHDenver and my second time moderating, so pretty excited. A lot of these panelists, some of them are my friends. So yeah, very excited to dive into tokenization of real-world assets. I figured we just start with some high-level introductions, although our MC kind of did, very, very high-level introduction. But I'm Alexis Johnson, co-founder and CEO of Lightnode Ventures. We're an advisory and marketing agency based out of New York.
I'm Caleb, based in Singapore from Helix. It's a RWA AI lending platform. Previously, I was a banker, and that's why there's an outdated photo of me with my suit and tie.
Hi, I'm Manrui. I am a co-founder of Untangled Finance. We are a credit protocol bridging real-world assets to DeFi. And we would like to be known for three things. Number one, we securitize private credit asset on-chain. Second, we have AI-driven credit modeling capabilities that allows issuers and investors to price these assets and monitor these assets. Third, we are building a liquidation mechanism for price discovery and for exit. Thank you.
Beautiful. I am Bhaji, the Chief Marketing Officer of Centrifuge. We are also a real-world asset protocol. We were founded in 2017, so have been pretty heads down building and learned and iterated a lot over the past few years. Excited to share more about that in the next couple minutes.
Hi, Sam Cassatt. I've been in this industry a pretty long time. I helped build a company called Consensus and funded things you all know and love, like MetaMask and Infura, that were seminal to the industry. Right now, I just co-founded a new company called Layer, which is an infrastructure stack using a novel WASM VM for performance and IBC for interconnectivity. And it is aimed at institutions, governments, degens, anyone who needs a platform that allows RWAs to be issued in a way that actually is amenable to the regulatory requirements and the real world use cases of those assets. So, thank you.
Awesome. Thanks for the intros. Now I'm going to dive in. So first question, as the RWA sector within crypto starts to evolve, what are some of the key essential elements needed for RWA infrastructure to succeed? Obviously, Sam, given that you're co-founder of a new protocol within the sector, I'll let you start it off.
Yeah, so I think one of the primary things is interoperability, and the other is really sovereignty, right? So I think what a lot of companies now are building is, if you look at something like DYDX, right, they moved to an L1. Why did they do that? If you look at what JP Morgan has piloted, right, it looks more like an L1. They really want control over who's a validator. They want control over governance, right? If you have an RWA where it's your house, and your house gets lost because you lost your private key, that doesn't really work, right? So you need regulatory compliance and you need governance that's actually capable of mapping onto the legal requirements of what an RWA might be. And then finally, I think on the interoperability side, if an institution can't send an asset to another institution, if you can't use the sort of money Legos that we all love in DeFi and compose them into more complex assets or derivative assets, it also will fail to capture the full power of what we want to do with RWAs. So I think those are two of the big features.
Awesome.
Yeah, I've got something to add. I think for real-world asset in terms of infrastructure, you're also talking about on and off ramp. I think even though it's getting better, it's still very difficult for an ordinary investor to get onto USDC, get hold of USDT or USDC, or vice versa. And then it's legal structure, because we are now kind of at the stage we're still talking about tokenization. That means that the asset not living originally or like authentically on chain to start with. You are tokenizing a financial receipt. Therefore, you need a robust legal structure that to actually protect the investor's interest. We don't have that. At least that's not what I've seen in the private credit tokenization so far. I guess the third is the liquidity part, especially for private credit. It's we don't have there is no secondary market trading of this credit, and as a result, that is almost defeated the thesis of the DeFi, where the flexibility, democracy, when you can get out, you can do it. We don't have that. Yeah, and lastly is the pricing oracles for real-world asset. All these 4 items, in addition to the infrastructure, are also part of the infrastructure that for DeFi RWA to succeed, in my view.
And the other thing I would add to that too is the use cases. So the partners that have a real need for this type of technology and ensuring that the protocols and the technology builders are building for that use case. So an example of that would be one of our partners, Block Tower Credit, where we're working really closely with them to understand what are the steps in the securitization process right now, what are those intermediaries, what role do they play, and what can we automate? How can we improve that and incrementally make every step a little bit better to ultimately improve the entire process? So there's so much we learn from working directly with those players who experience this firsthand and know the pain in the traditional financial world and see the value and see the opportunity in the DeFi world and want to co-create, because we're not there yet. There's still so much infrastructure that needs to be built, but those partners who see the vision are those that are going to build it with us.
Yeah, just to add on, I think everyone has brought up a lot of points. So I'm trying to figure out where I can add. So just to add on with regards to data security, I think if you're facing an institutional client, there's a need to ensure compliance with KYC, AML, also need to maintain compliance with data protection laws, right? So how do you do that? I think I do see that there is a need for ZK proofs, like ZK Sync, fully homomorphic encryption, secure MPC, just to maintain secure private transactions, while also giving some necessary oversight. Another thing that I can also include would be in terms of AI. And right now, AI is one of the biggest driving factor for crypto as well. And I do see that in RWA, there is a need to catch up. So I myself, because we are building an RWA AI platform just like her, so AI actually helps to streamline the risk assessment process to give you better and faster data-driven decisions that could be used for equities, bonds, or even commodities. Yeah, I think that's all for me.
Awesome. Next question is more geared towards both Helix and Untangled Finance. How are companies taking advantage of tokenized credit?
Okay, so we didn't introduce much earlier. So previously, I was the ex-interim head of Huobi Ventures before Justin Sun took over. And we actually run a Web2 business for the past 6 years called Helicap. It's based in Southeast Asia. It has a perfect track record of 0 defaults thus far since inception. And to be honest, when we actually look at this industry at Helicap's standpoint, we realized there was a need for stable, uncorrelated use to crypto, and also not only that, also a reliable borrower pipeline. So eventually, because of Helicap's track record and consistent use, we decided that building Helix would be an ideal fit to tap onto this liquidity. So in terms of taking advantages, I would say it comes in 4 points. First thing, it allows us to go beyond Southeast Asia, tapping on through blockchain, being able to go global. That's number one. Second thing, an on-chain reputation for borrowers, because a lot of our Southeast Asian borrowers can't tap onto banks because they're too small or they lack the reputation. Number 3 is in terms of liquidity. I think like what people has mentioned here as well, you're able to tap onto the global crypto liquidity. And last but not least, you get diversified across numerous lenders, not just TradFi lenders, but also crypto lenders as well. Yep.
Here, I take companies as our customers. Like one part of our customers basically are the borrowers, are the originators, are the fintech lenders. These are innovative group of tech-savvy, innovative people who set up their business to take the risks the bank cannot take. And these people are hungry. All they want is to diversify their funding base. They honestly don't care whether it is on-chain or off-chain. And DeFi is a different financial rail to traditional financial market. Here, you not only help them to diversify their funding base, you kind of help them to do it in a different rail. And they love that because they don't want to be dependent on one single funding source, and that is the killer. because we have worked with one of the European originator, fintech lender, because they were funded majoritarily by Greensill. And after it collapsed, their book basically have to shrink down to a quarter of what it was before. So DeFi is an innovative and arguably better financial rail for many of these innovative alternative lenders, only if you do it right. we don't believe in direct lending to SMEs in emerging markets because that's why these lenders are there for. We don't know them enough to take these kind of credit risks. That's why we do securitization. All the things are granular, all the assets are granular. The pool is backed by tens of thousands of assets, and it's originated by kind of accredited parties, by experienced fintech lenders, and it's being vetted by financial institutions. So I think being able to bring good quality asset on chain is the primary importance for DeFi to continue to grow.
Awesome. And my next question is for all panelists. What are some of the benefits of tokenizing real-world assets?
I guess I could start. I think there are a few, and one of them was just highlighted by Manrui, which is that there's a long tail of assets that normally are either too frictional or too small for traditional financial institutions to engage in them. And now, if you sort of look at what the internet and the startup culture did to the rest of commerce and the rest of business in the world, it created sort of this Cambrian explosion of creativity and of new types of businesses that wouldn't have been possible. IBM wasn't going to build that, Microsoft wasn't going to build that, but a startup could build it. And so, it benefits our society, and it benefits sort of like the goal of financial inclusion in general of the entire planet. If kids in startups with a computer are suddenly able to build financial products, so that's one thing. Secondly, I think building on that as well is really like the composability and the maneuverability and the agility of on-chain assets. Because if you take traditional assets, just zooming out big picture to like the vision of why we're all doing this and why we're here, right? Normal assets move at the speed of a boardroom, and they move at the speed of pieces of paper, right? And if you have a 100-page legal document and lawyers reviewing it and boards approving it or whatever, committee approving it, that's a lot different than some people being able to code something up, verify it against an Oracle or verify it against an on-chain reputation, credit score, whatever, and then just issue these assets and compose them into new assets. So I think, in general, we're opening up a new phase of accelerated growth, accelerated innovation that comes much more cheaply and is more accessible to everyone on the planet. I think that's the big picture why.
And I can give two specific examples of types of assets and the benefit that blockchain and on-chain finance brings. If you think of like real estate, for instance, there's a big wave of tokenization for real estate assets. What's needed there is fractional ownership and liquidity. So if you invest in a real estate asset, that might be held for 5 to 10 years. If you tokenize that, then you can make that more liquid, and you can fractionalize that. Another example would be like the 2008 financial crisis, right? We were trusting the banks, and it was completely opaque, and we had no idea what the underlying loans were within those securitizations. Something like that would never happen on blockchain, because every single loan, every single deal, all the way down to the very bottom, has the ability to be viewed and to be reconciled by anyone at any time. So those are like two very opposite side of the spectrums, but indicative value that blockchain can bring to the real world, to things that we've experienced firsthand.
Yeah, I really like the word composability that Sam just mentioned. That is the beauty of DeFi and blockchain that brought to everyone. It is just so easy to move values around, and that's great in the case of financial product, creating access. But I also want to kind of come from a DeFi perspective. Now, if you look at DeFi, we're talking about in billions, and majority of that is crypto assets. In order for DeFi to grow, you really need to tap into the $1 trillion of real-world finance market, don't you? And it is also a way where you really kind of show DeFi's value to the regulators, to the governments, that you're actually funding the real world economy and having a way for government to actually apply tax on you. Yeah, I think that's also one of the benefits. And from a crypto investment perspective, you know, all these real world assets, they have intrinsic value. They're based on contract already performed, goods already delivered. So therefore, they have intrinsic value that is not subject to crypto up and down. I know we're in another bull run, so it might be the bear market for real world asset. But you know, this is the most sustainable type of returns, regardless whether it's rainy days or sunny days in DeFi.
And I think the interesting thing is it doesn't all have to be that. There can just be a diversified portfolio where you can do some speculative, fun crypto trading, but then you've got a part of your portfolio that's stable yield, that's in T-bills or in structured credit, and you think of a more like treasury management approach to managing your on-chain capital and growing that.
Yes, I think everyone brought up good points again, so I'm left with a few. So I think the first thing that came to mind when she mentioned composability and interoperability, I think that struck a chord in me because imagine being able to use OUSG from Ondo as a collateral to borrow against other assets. So I think that's something interesting. It hasn't been implemented, but there is one instance by Hashnote and Noble. They are coming up with a stablecoin called USCY, and it's actually backed by treasuries. And you can use it as a collateral across the Cosmos ecosystem. So I think that's one very good use case. I think maybe that's on that side. Besides that, I think on the borrower side itself, on the RWA issuer itself, right? How it benefits is in terms of 24/7 settlement. Like I think previously with bonds, you got T+3, T+5. Those are hella long, man. I mean, now with blockchain, it's instantaneous settlement, 24/7 settlement, and you get access to global crypto capital. Yeah, I think that's all for me.
Although I have to disagree on that,
Yep.
because this 24/7 settlement is a little bit deceiving at the moment because the assets are not living organically on chain. So we are basically doing a lot of things to wrap a real world asset in a real world financial receipt form into a token. So you still kind of have to follow a bit of the real world practice in terms of timing, how interest rates are calculated and reconciliation. But I do believe in a world that hopefully soon, that with the legal framework, with the AML compliance, with all the things getting ready, that we have loans that originated on chain, like invoice issued on chain.
So yeah, just to expand on that, I think the merging of governance with the legal structures is really where it gets very interesting, right? Because the only reason a piece of paper is the asset is because that's what our society agrees to when we write it on a piece of paper, right? But like even 2 years ago, SocGen issued a bond, like $100 million bond on Ethereum, and they said, well, this legally is the definition of this bond. There is no wrapping, right? It is that, right? And so I think as those structures mature, then we will have that. And I think bear market or not, trillions of dollars into TVL of any platform that's doing real business and providing a real service is a beautiful, wonderful thing. Probably not that bearish.
Bullish, I like it.
And so next question you guys touched on before high level, but which sectors within the economy are most likely to embrace tokenization first?
I'll start first this time. Okay, thank you guys.
Go for it.
So for me, I mean, this is my personal view. Okay, it might be wrong. So I would first say stablecoins. Stablecoin is still a form of RWA because it's tokenized fiat, followed by financial instruments like equities, fixed income, fixed income. And next will be real estate, and followed by other asset classes like healthcare, supply chain management, and IP management as well. I think the reason behind all of this is because for stablecoin, it mirrors what you see with fiat, right? And there's stability. So it's very, very easy to actually integrate stablecoins into financial systems. And I think for me in Singapore, MAS has already started regulating stablecoins. So given that, I do see that stablecoin will be the forefront in terms of mainstream adoption for RWA. Second would be, like what I mentioned earlier, financial instruments. If you look at market cap itself, financial instruments is the highest or second to stablecoins. I think it's higher than real estate, higher than all other asset classes as well. I think the reason being is because people are familiar with the asset class. be it equities or be it fixed income like government bonds. And in terms of the asset class itself or for financial instruments, I believe that it will follow the risk curve, the adoption will follow the risk curve. First, people will take the lower T-bills, lower risk T-bills, subsequently then expanding into private credit, bonds, and also receivables. That's on the, again, the financial instrument side. The third one is the real estate. Real estate is second to financial instruments. And the reason being is because it's tangible. So when it's tangible, you got, again, like very complicated local regulations that are governing these properties. It could be in the form of taxes or property management, and also in the form of, and second thing is properties itself is tangible, so there will be property maintenance and insurance as well. So there's a lot of considerations. And last but not least would be the asset class for supply chain, IP management, and healthcare. Yeah. So in that aspect, again, there is complex regulatory frameworks that need to be resolved. Second thing with regards to there needs to be tailored blockchain solutions for some of these products like IP management as well. So in that order, I do believe that will follow the trend for RWA. Yep.
For me, I'm probably biased. I believe it's private credit for a few reasons. First of all, it offers a very good risk-adjusted returns. I know that it's not going to be like the 10x, 5x, 100x that crypto investors are looking for. However, these are very good double-digit returns if you do it correctly and with the right partners. And then these private credit these lenders are often lending to the real-world economy to give access to finance to SMEs. So from that perspective, it's really open up the access as well. And private credit opportunities in the real world is very not accessible at the moment by ordinary investors. Whilst it's very easy to get access to treasury products, regardless whether you're on-chain or off-chain, but it's not the same for private credit. It is traditionally only available for financial institutions, but we can use DeFi to open up this access.
We love private credit too, and that's part of some of the value of securitization because it's so much more powerful with blockchain. We also like to just kind of think about like longer term, some more speculative use cases and asset classes. You touched on it a little bit, but supply chain finance is a good example. And the founders of Centrifuge previously founded a company called Talia, which did supply chain finance. And that's essentially like, in the most simple terms, it's like Coca-Cola and Ford and these major Fortune 500 companies take 90 to 120 days to pay their suppliers. So they're going to pay their suppliers, it's just going to take them 4 months. So capturing that opportunity and paying those suppliers early and then having Coca-Cola pay you is this like really powerful use case where it removes a lot of risk from the process, but it's pretty complicated. There's a lot of like shit that goes on behind the scenes. And that's another really cool potential application of blockchain. So ultimately, like we build for what the investors are demanding right now, and that's a lot of the lower risk stuff. That's a lot of T-bills, that's definitely structured credit, but we still have these visions of like music royalties, emerging markets, supply chain finance, just like carbon credits, everything could come on chain.
Yeah, I think those are all great answers. I guess I just really want to offer the observation that it seems like access and like sort of stability are things that we're sort of moving down the curve of, right? So we already have USD representations, right? Everyone in the world wants to use USD. It can be frictional, and that's why we have so much of it. And some of the best real business models in blockchain are just moving USD around in various forms. And then you go down the curve, and you have things like T-bills, right? People want access to them. It's not necessarily easy in an emerging market, for instance, to get access to T-bills. Even if if you have good banking relationships, you can. But a lot of people don't. But suddenly on chain, you have access to those things. So I think if you look at what do people want the most and the scale of what they want the most, like those are the things that are already on chain, and we're seeing it first. So just making that observation that we're moving down that curve as this progresses.
Yes, and so my next question is for panelists. how will tokenizing real-world assets help developing countries?
So, so that's sort of what I was just saying, right? People, the U.S. dollar is the gold standard of how to transact, and now people can have U.S. dollars. We can also have UST bills. I think also infrastructure, the way we build it, is actually a lot cheaper, right? So, for instance, I remember sitting with a friend of mine who was the prime minister of Haiti, and they literally had during a hurricane, the building that had all the land records washed into the ocean, and they were like, "Well, guess we don't have all the land titles anymore. What do we do now?" Right? So I think there are systems that can kind of be leapfrogged because of the way that titling and RWA assets and the sort of legal and governance link, because you get a lot of that for free, or you get a lot of that in a way that's scalable. Emerging markets can take advantage of things that would normally require a very expensive set of governance and set of institutions in order to administrate. So that's an obvious one.
And people sometimes just forget the simple store of value use case of stablecoins. In emerging markets, you don't always have the confidence that your money in the bank account is safe. So that's you see a lot of more utility in just the pure stablecoin use case.
Yeah, I really echo Sam's view on this leapfrogging. Developing countries, their financial market are less developed in the sense that they develop later, and that gives them a perfect opportunity to leapfrog and utilizing all these new technologies that we currently have. Now, for European banks and American banks who've been around for so long, their legacy system go back to 1970s. It is so hard for them to adapt anything new, and we had live experience on that. We helped Nigerian banks to help their SMEs to access to finance via Nigerian banks through the model that Bhaji, you just described, that supply chain finance. Basically, we have deals with very big companies in Nigeria, and it takes them 180 days, by the way, sometimes, to pay their suppliers. And then we kind of to get the credibility of these large companies, and then the bank would advance to the SMEs using the blockchain tokenization. That's back in 2018. Yeah, so that's one of the ways that emerging market can take advantage.
Yeah, just really quick, I often hear a lot of people, especially during bear markets, say, "Why do all this stuff? Why is this interesting? Aren't you just recreating what already exists? It seems like just a way to make money or something." But tell that to someone who literally doesn't have a credit system or doesn't have a land titling system, or their currency is hyperinflating right now. There's a huge use for everything we're doing.
Totally. Also, in those markets, for example, the farmers or the smaller businesses, they are very much agriculture based. So they have inventories, but these inventories are dead at the moment and illiquid. When you tokenize, become a warehouse receipt, they become liquid. Then they can move around. That is extremely helpful for those countries.
Okay. Yeah, I think just to add on to, I think everyone has been mentioning a bit about supply chain, and I mean, from where I come from in Singapore, in Southeast Asia, I think there is a lot of corruption. There's a lot of traps that's set by some of the companies in Southeast Asia to try to scam you, right? So in terms of the blockchain itself, I think what it can offer is transparency. So for me in Malaysia, so there is a Malaysian Palm Oil Council. So they actually started this traceability pilot program to actually trace how the palm oil is being sent from Malaysia to the different parts of the world. And in the event there is again some kind of abuse in terms of children, I think they can identify it through the blockchain as well. So essentially it's just solving environmental and societal issues that is faced by emerging markets.
And so my next question is more focused on, the barriers and challenges that, will come up and arise as you as companies, tokenizing real-world assets. Are those challenges more legal related, technical related?
Should I? Okay. There are a lot of challenges. I think I will only talk about private credit because that's what we believe in. As treasury bills, you can get it off-chain. Private credit, you can't. For private credit, from the last bull run, we now have about 500 million US dollar worth of private credit, like in terms of TVL. But there are a lot of these assets are perhaps not as very good quality as it could be, because in last DeFi bull run, like lots of borrowers, they couldn't get the real world kind of finance, like from TradFi, and they see liquidity in DeFi, they jumped in. And then some protocols offer like yield farming opportunities to then add on to the return that these assets are promising. And as a result, that some of the less good quality assets were brought on chain to start with, so they are more prone to default. And then at the same time, the investor don't have a way to really value this asset. They don't know how should they look at these private credit asset, because private credit assets, they are private for a reason. Many of these things are secretive, that originators don't want to disclose these kind of things. And how do you make private credit like public and but yet private again? That's kind of with ZK knowledge proof that we kind of are developing with some partners right now. So some investors are getting double-digit return, like 12%. But what they're really taking on is equity risk, and that obviously don't add up. And then the third, which is compounded or make it all these worse, is the lacking of liquidity, lacking of the ways to actually liquidate. There is no secondary market trading of these tokens. So all these things combined, when there is a default, then investors don't know what to do. And all these were compounded by the fact there is no good legal structure protecting investors' interest. It took us, with our partner Fasanara, nearly 6 months to set up a traditional securitization structure in Luxembourg that is token-friendly and regulatory in compliance. You don't have that with other protocols.
I just want to take it from the technical direction. And it's really nice if you can tokenize something, and as you said, you can have this token sit there, and that's great. But if you actually want to realize the vision of DeFi, and it's not interoperable, you can put it on some ATS, and each ATS can integrate some kind of specialized API call into your specialized chain that doesn't talk to any other chain. That's not the end game here. The end game is that they can all talk to each other. They all meet some kind of standard that we all agree upon, or sets of standards. And technologically, those things can move around. Otherwise, really all you're doing is you're having a different kind of ledger to take, to record the same things. So I think interoperability of both standards and the technologies is really one of the challenges for us to realize this vision.
And another challenge we've seen is that, the reality of it is we are still so new. And back to the infrastructure question, there is still so much that needs to be built. So it's still the kind of early adopter visionaries who might need to run parallel systems and run everything off-chain and ensure that we're kind of crossing all the T's and dotting all the I's. So they aren't necessarily saving the full potential yet, but they believe that they will in the future. So it's still early in so many ways, and there's still so much infrastructure that needs to be developed. But that's why these conversations are important, and that there's this kind of call to action for these builders and for these new players to come in and start to fill some of those gaps.
Just to add on, I think we've got 1 minute left. So, so with regards to the points, I think some of them mentioned, I think there's a need for a secondary marketplace, right? So currently, I mean, private credit, I'm also doing private credit. So the deals are, it's large, and it's it doesn't happen every few seconds, right? It's not AMM model. But what happens if you bring it to the secondary loan marketplace? Currently, what we are doing actually is we're already doing some OTC transactions with our Web2 business. But if you bring on-chain and transactions happen too quickly, I mean, the gas fees will be high, right? And as of now, as you know, Ethereum gas fees are crazy, right? And it's probably more expensive than your old school banking transfers. So I think what we need is probably scalability infrastructure, be it rollups, ZK Sync, Optimism, that will help a lot with RWA as well.
Or layer.
Yes, outlayer, yes, sir. Yes.
There you go. Nice plug.
Awesome. Unfortunately, we're out of time, but I'd like to thank everybody for tuning in and the panelists for their contribution.
Thank you.
I love that we've got the strategist, the operator, the salesperson, the marketing person. We're like the founding team.